We have still 57 million Americans who don't have any savings or any retirement plan.
Whether it's state-funded pension plans for teachers and policemen or Social Security for everyone, we all know about the looming problems in providing adequate income for retirees in the United States. But it's not just the U.S. that has a problem.
Many countries made provisions for those promises, and now promises are being cashed in. And many countries are saying, oh, wait, we don't want to pay the bill.
Teresa Ghilarducci is professor of economics and policy analysis at the New School in New York and author of Rescuing Retirement with Tony James. The challenges faced by retirees around much of the world are reflected in higher poverty levels of those over 65, with the OECD reporting that 40% of the elderly in Korea live on less than half of the median income in the country, and the United States just under 25%. Ghilarducci says one of the reasons is lower interest rates.
The life expectancy does not put a strain on pension system, but what has changed is over the past 20 years, there was a regime of very low interest rates, for lots of reasons. One of them was the financial crisis. A lot of it was the way that we managed our economies was to make sure that capital investment was low. That distorted a lot of decisions, but one of those things that it distorted is that the safe assets, like government bonds, didn't pay as much.
The U.S. is hardly alone in facing the coming retirement crisis, but one country, the Netherlands, is doing something about it. Adrian Rijker's firm is one of those putting those funds to work.
In the Dutch pension system, in the second pillar, there are around 1,600 billion euros of assets under management, which equates to around 1.5, times the GDP of the Netherlands.
That 1.6 trillion euros in Dutch pension assets accounts for 59% of all European pension funds, while having only 4% of the population, which means that it ranks near the bottom of the OECD numbers in elderly poverty at just under 5%. But despite having more assets set aside for retirement than any other European country, the Netherlands is about to overhaul the fundamentals of its pension system.
Now we are moving from defined benefits to defined contribution. And the reason for this change is mainly to increase the sustainability of the fund towards the future.
At first glance, the math seems straightforward. The old model wasn't sustainable. It was time for something new. But the debate over restructuring the system was anything but simple.
The private pillar is what is in the process of getting reformed now. That reform took a number of years to reach. Discussions started in the early 2000s after the dot-com crisis, when a number of Dutch pension funds saw their coverage ratios drop. It came to a conclusion sort of around the start of the pandemic, when the shape of the current pension reform was decided upon.
Stan Veuger is a senior fellow in economic policy studies at the American Enterprise Institute and director of the Netherlands America Foundation.
That didn't mean, of course, that the political discussions around the reform completely dissipated. In the outgoing government, the Schoof cabinet that was in place for the past year or so, there was one political party, the New Social Contract Party, that was quite aggressively opposed to the pension reform as it had been designed. And they, in fact, tried to derail it by letting individual workers and retirees vote on an industry-by-industry or occupation-by-occupation or even firm-by-firm basis on whether to remain under the old pension system, which is a defined benefit system basically, or whether to accept transition to the new, more collective defined contribution system. That effort by them ultimately failed. It lost a vote in Parliament, but only barely. And I think that was really the end of political uncertainty around this pension reform. Not only because that vote failed, but also because the Schoof government fell this summer. We had elections, and the party most associated with those efforts to basically undo the pension reform to a significant extent, that party lost all of its seats in Parliament.
The Dutch pension plan changes may be controversial, but necessary, given the larger forces that all retirement plans in Western countries are facing.
The move to defined contributions is something that we see all across the globe. If we look at the pension index that is published yearly. If you look at what pension advisors and actuaries are saying, exactly, these changes are not specific to just the Netherlands, but because we have such a large pension buildup, we have so much capital in the system, very high adequacy rates, it is very prevalent in the Dutch system. Since the global financial crisis, interest rates have been in steady decline, mainly because of monetary policy and because of the way that pension liabilities are valued. They have a direct link with interest rates. And as interest rates decrease, the liabilities of pension funds increase and thus place a burden on the pension fund's sustainability. But also on top of that, you have longevity, which has increased amongst the participants. And coverage in the Netherlands of the second pillar pensions is very high. The way in the old system that we had, the way it worked is that employees would usually stay at the same firm that they started at or stay within the same industry and work until their retirement age. And if this happened, the current pension system was perfectly equipped for this. But nowadays, we see more and more people moving away from a lifetime employment and moving more into self-employment.
One way to address the increased number of people relying on their pensions amid lower interest rates might be to extend the time when people start receiving their benefits. But that is not the way the Netherlands chose to go.
The reforms mainly are in the way we invest and changing from defined benefits to only defining the contribution.
The Dutch system is designed to increase the size of the available pie by permitting pension asset managers to invest in higher risk and higher yield assets for younger workers with many years to go until their retirement.
You now go to a more individual approach with your collective investments in that you have to see what individual investors need at certain age groups. So for instance, a young person on average has less financial capital, but still has a lot of years to work in its career. And what that enables younger investors to do is to take on more risk, because the biggest determinant of capital buildup at a young age is the contributions you get each year. But as you near the end of your career, contributions become less of a big part, less of a big influence on the income that you will have on retirement. And the income or the focus shifts from contributions to investment results that should be stable and lower in shocks.
Whether permitting more flexible investments, particularly riskier ones for earlier in a worker's life, will work or not, it does relieve the pensions from facing obligations greater than their resources, but also means that one's benefits could go up or down depending on the markets. Getting people to agree to this big change took time and all the stakeholders working together.
One distinguishing feature of the Dutch system of policymaking is that there is a lot of focus on consensus building between employers, employees, and the government. The fact that the Netherlands has these structures that facilitate the coming together of business and labor, I think is particularly helpful in the pension context. There are lots of political problems where there are all sorts of other stakeholders involved, but in the pension context, it really still is employers and employees who have to come together and reach agreement on how to design the pension system.
What can the rest of the world learn from the Dutch in providing for retirement? Perhaps a lesson in persistence. The most recent changes are just the latest in a series of attempts at pension reform.
Go back to the 80s under Ronald Reagan, when they did take steps to try to extend Social Security. What made it possible then that doesn't make it possible now?
Well, what made it possible for a bipartisan commission and a fix to happen was that the crisis was only 1 year away. It had to do with surprise inflation and a surprise among the actuaries that they wouldn't have enough money in the shortfall. So money needed to be infused into the system immediately. And so the Greenspan Commission under the Reagan administration recommended that the payroll tax be increased. And everybody agreed. Later, when it came to Congress, there was some political effort to say, well, if we're going to raise taxes, we have to really look to see how much the taxes have to be increased. And so that's when they looked at the past and said, well, since everybody's living longer, then we should have a system that represents that, and we'll raise the retirement age to 67. But that cut in benefit was going to be in the future. And they all agreed they needed an infusion of cash, and taxes were increased. Maybe that's what we need to raise taxes, is to have a real look at what taxes pay for. And everyone likes their Social Security benefits.
Whether it's relying more on the capital markets like the Netherlands or turning to taxpayers to contribute more, the United States and other Western nations have some tough choices to make, and they need to be made sooner rather than later as people live longer and we want to provide for them without stealing from the future.